Are you looking for high powered career opportunities in corporate finance? Or looking for understanding the building blocks of corporate finance, which helps in your academic learnings? If yes, this course is for you. The course represents the theoretical context for understanding and analyzing major financial snags of modern business firms. The course is engrossed on building skills in analyzing the typical corporate behavior in capital market operations. The course interprets the affiliations of agent and principal in raising funds and allocating capital, distributing returns across all the stakeholders to the business. The course also offers requisite knowledge for evaluating management decisions in creating value for the business. Before we dive into today's topic, let me take a minute to introduce you to Great Learning Academy, a free initiative by Great Learning, where you will find more than 200 courses around trending domains like data science, machine learning, artificial intelligence, programming, cloud computing, digital marketing, and many more, absolutely free. These full courses are designed by leading industry experts and professors from prestigious universities and EV League schools. And for those who are comfortable in Hindi, we have courses available in Hindi as well. The best part is once you enroll for these courses, you will get access to a lot of learning material along with the course videos and earn a free certificate on completion, which will be a great value add to your resumes. So make sure you check out the links in the description below this video to access relevant courses on Great Learning Academy and enroll for courses of your choice. If you are a fan of our videos and haven't subscribed to our channel yet, don't forget to hit the subscribe button now and ring that notification bell so that you don't miss out on any new updates or video releases from us. And if you enjoy this video, show us some love by liking this video and share it with your friends and colleagues. Make sure you put down all your requests or ideas for new videos that you would like us to cover in comment section below. Hello, welcome to the introductory session on corporate finance. My name is Pawan Kumar Chandrapa. Corporate finance is not a new subject. The subject has its roots way back in 15th century. But the subject started gaining traction only by 1900, especially after the mid of 1950s. Earlier, the subject was discussed as a section, as a part of financial accounting. But now, the subject has grown so big, which requires a minimum of 1 year to understand the length and depth of this particular subject. So it largely discusses about the time value of money, one of the building blocks of financial management, the sources of funds, the mergers and acquisitions, capital structure, raising capital, financial derivatives, and capital budgeting. So in this session, we are not going to cover all of this. We are going to handpick some of the important topics that are prevalent in corporate finance. So in this session, we'll be discussing about what is corporate finance decisions, capital budgeting techniques. We'll be discussing about the capital structure and mergers and acquisitions. What is corporate finance? If you ask this question to different individuals, you would get different answers. Some people may claim that corporate finance is a part of financial accounting. Some people may claim that it is just an extension of financial accounting, or it is all about the financial modeling. Or some people may say that it is all about investment decisions and capital budgeting techniques. Though all these answers are correct, but none of these answers are giving you an appropriate picture of what is corporate finance is all about. Before we dive deep into understanding what is corporate finance, let us quickly take a real-time example, a real-time daily life example, so that it gives you a perspective. Let's assume that you want to start a business. Okay, so you want to start a business. Let's say it is a small manufacturing firm you want to start with a limited number of employees. You want to start your business. What is that you need? What is that required for your business? It would be the idea, which is most important and the first important thing. You need to have a business idea. A business idea, when I say business idea, it would be a practical business idea or a feasible business idea, right? Then what else we need? We need skills. Skills to perform duties to succeed in the business. What else? The most important ingredient for business is money. Money is required for virtually everything in business. When we say money is required in the business, it would be for various reasons. For example, it would be to pay your suppliers, to buy raw materials, to pay your employees, to pay the stationaries, to pay the rentals. It may be for any reason. Now, money is required, inevitable for business. We need money. Without money, we'll not be able to start the business. Technically, it is not possible to start a business. But where do we bring the money? A businessman can find various routes to find this money, right? Because this money is not available free of cost. This is not in abundance. This is a limited resource which is coming with cost. For example, if 10,000 rupees need to be received from some external sources, it would come with its own cost. Now, when we say the money is important for a business, the same thing is true with a corporate also, with a multinational company also. They also need money for various reasons. For example, to pay day-to-day operations of the business, to take care of daily expenses, to pay salaries, right? To pay service providers, to import raw materials from various locations, to pay the rentals of the buildings, the assets, to pay off the existing loans, or it may be to acquire new assets. It may be any of these reasons. So in that context, corporate is business, finance is nothing. It's all about money, a corporate finance. So now let us understand the definition of corporate finance so that it gives you a right perspective about what it is all about. Corporate finance is a broad area of finance that discusses about the sources of funds and the application of funds and the strategic decisions that finance manager take to increase the value of stakeholders. When we say the sources of funds, that means from where a businessman can bring money. What are the sources available? What are the options available to raise funds? When we say the application, right? The application of funds. When we bring money into the business from various sources, how these funds have to be utilized, how these funds have to be allocated for optimum results. In business, every choice that a business makes has financial repercussions or consequences, and any decision which touches the finances of a business is all about corporate finance. Largely, all that a business does comes under the rulebook of corporate finance. Now, let's understand the goals of corporate finance. Why the corporate finance is, demanded so much, why it is growing to become a separated division in every corporate. Why companies are having their own corporate finance divisions? Why it is so important? Survival of the business is one of the most important goal of corporate finance. Corporate finance focuses more on the survival of the business rather focusing only on the profit maximization. Because when the business is able to survive during the tough conditions, the business will ensure it will take care of profits in the better conditions. And I think that is the reason why companies have been focusing more on survival even now during the COVID pandemic, the ongoing pandemic. The business firms, the corporates have been focusing more on survival than focusing more on profit. I think that is the reason the companies have been focusing on cutting cost, cutting expenses, expenditure, cutting the salaries, cutting the infrastructure cost, and cutting their employees, right? So they're focusing more on the survival. The corporate finance focuses more on the survival of the business rather focusing only on profit maximization. Beating competition is another important goal of corporate finance. Beating competition in the sense when a business is running, it is not running alone, right? So every business will have alternative, every business will have competitor, every company will be having competition in terms of price, quality, quantity, market share, geographical market share, and in all other aspects. So beating the competition is another important goal of corporate finance. Maximizing sales, maximizing market share are the goals of corporate finance. Every company prefer to maximize sales, thereby maximize the market share. Every company wants to become number one, two, three. They want to be ranked first in the market. So every company strives towards that, and corporate finance goal is one among corporate finance is focusing more on maximizing the market share. Minimizing the cost is another important goal of corporate finance. So every attempt of the business should be focused towards minimizing the cost, maximizing the results, minimizing the cost, maximizing the value for the business. But everything ultimately boils down to maximizing the value of stakeholders. So that is the ultimate goal of corporate finance. So maximizing the value of stakeholders. When we say the stakeholder, who is the stakeholder? The stakeholder is the person or a group of persons who are interested directly or indirectly in the business, who have active or inactive roles in the business. They may be internal or external to the business. Who are the external people who are interested in the business? Who are the external stakeholders to the business? They may be customers, they may be current customers or the past customers, or they may be the potential customers who are about to buy, about to become your customers. The suppliers, people who are actually supplying raw materials and other, the basics for manufacturing or services. They may be creditors, people who have given money to a business, the investors who are interested in the business, the tax authorities. The tax authorities are the people, their tax authorities will always be interested in business because they expect every business to pay tax according to the law of the land. The media continuously and closely monitors the functions and the operations of the business. The government agencies will also monitor the activities of business. So these are the external stakeholders to any business. Now, who are the internal stakeholders to the business? They may be shareholders, board of directors, employees, managers, auditors, or legal consultants or tax authorities. So these are internal stakeholders to the business. Now, Let's understand corporate finance decisions with a small example. Let us consider a company is planning to spend 10 million for acquiring new assets if the proposed business project is approved by the client. So what are the corporate finance decisions to be taken in this case? A company is planning to spend 10 million for acquiring new assets considering a new business project. So what are the corporate finance decisions in this case? Should the project be accepted or rejected? What is the expectation of investors? Whether the investors are looking for profit or they're looking for capital gain. What are the cash flows from the project? So when the cash flows are expected to begin? How long the cash flows are expected to continue? When the project would break even, when the business would reach no profit, no loss zone. Break even is nothing but no profit, no loss zone. That means this is the point at which the total cost incurred by the business and the total revenue generated will be equal. And beyond this point, the business will start generating profit. Until then, it was a loss, and after that, it would be profit. But the break-even point is no profit, no loss zone. If this project is not accepted, how company can utilize 10 million? And what is the opportunity cost involved in this particular project? Opportunity cost means the cost incurred by the business by taking this particular project. If this project is not accepted, what else the business would have accepted? To explain this particular topic, opportunity cost, I would like to take a small example. Opportunity cost. Let's say there is a popular lawyer in a city. Let's say he's a civil lawyer. He's too good in handling civil cases and is very popular. At the same time, the lawyer is very good in typing. So most of the time he prefers to take care of his typing activities by himself. So in this case, what is the opportunity cost? Just because the lawyer is too good in typing and is too good in law profession, he should not be going towards typing. That means he should not be spending too much of his precious time in typing, because his time is more valuable in law profession than in typing. Instead of spending so much of time on typing, he can just hire an accountant or typist who can just take care of typing activities, and the lawyer can pay the minimal salary to the typist and focus more on law profession to earn more and more business projects, more and more cases. Not the business projects, it's a cases, right? So that is opportunity cost. What is the cost incurred by choosing an alternative? What is the dividend payout plan when the company is planning to pay the dividend? Whether the company is really interested in paying dividend or they just don't want to pay the dividend, rather they just want to make it a capital gain for the investor. Now, let us understand the nature of corporate finance decisions. What are the typical characteristics of corporate finance decision? Long-term orientation. The corporate finance decisions are taken from long-term perspective, and the decisions taken will have long-term repercussions. The decisions taken under corporate finance will have long-term goals. Most of the time, the corporate finance decisions will not focus too much on the tactical activities or day-to-day operations of the business. Rather, they focus on the long-term goals of the business. That may be creation of value, maximizing the profit, maximizing the wealth for the stakeholders. So all long-term orientation. Decisions on the large investments. So it largely discusses about how the large investments can be brought into the business. Okay, so when, what kind of investments can be brought in, what is the cost to be incurred, to bring that particular fund. So the large investments, where to invest money, from where to bring money to the business. So this is all about that. Impact on the financial results. The decisions taken under the umbrella of corporate finance will have, the financial repercussions on the business. It will directly hit the top line or the bottom line. It may be the gross profit or the net profit. High notch of risk. The decisions taken under corporate finance will have high element of risk, because every decision will have its own consequences. It will be like a double-edged sword. So either way, it would hurt the business. Sometimes it would bring benefits, but most of the time the decisions taken under corporate finance will have, the risk. Irreversible in nature. Like once the decisions are taken, it cannot be reversed. The business cannot reverse the decision. Once it is taken, it is done. So the business can just expect the consequences or the results. That's all. They cannot reverse it. Now, let's understand one of the most important topic in corporate finance. This is agency relationship or principal agent relationship in corporate world. Most of the time, this becomes a serious problem in the corporate world, and sometimes the companies close down because of this particular reason. Okay, so before we dive deep into understand what is principal agent relationship in corporate world, let us quickly have a look at a simple example, simple daily life example, which would give you a different, the right perspective to understand what is principal and agent relationship in corporate world. Let's say you have a car. Okay, you have a car, and there is some problem in your car. There is some noise coming out from the engine part of the car, and you prefer to go to the garage to test it, because you don't know, you're not from mechanical background, you don't know anything about that, and you want to take your car to the garage. Now you take your car to the garage and connect with the mechanic. You will instruct him to check the problem. What is the problem in the car? Because you're experiencing some noise coming out from the engine. Now, by giving this responsibility to the mechanic, you know, so you're just asking the mechanic to just check what is the problem. You'll become the principal, because you're instructing. You are the owner of the asset. You are instructing to mechanic, and you are the principal now. Now, mechanic is accepting your order, and you need to work according to your best interest. What is that you asked? You asked him to check the problem in engine part. Now, it is the duty of the mechanic to check and tell you what is the problem. You should do that, because he is your agent. You are the principal, he is your agent. The duty of agent is to work according to the best interest, according to the best interest of the principal. What is principal expected is the same thing you need to do. Now, if the mechanic do the same thing, he'll just check the car, and he identify the problem, he let you know this is the problem, this is the exact problem. There will be no agency problem that arises between you and the mechanic. The principal and agent relationship is smoother. But most of the cases that won't happen. Let's say in this example, mechanic don't want to disclose the actual problem. He would come and suggest you to go for a costly repair work, which would cost you some 20,000 rupees, right? But the actual problem is just it's a nominal problem, which could have been solved by taking a repair work at least within 5,000 rupees. But now mechanic is trying to reap maximum benefits from this opportunity. He is not ready to work according to the best interest of the principal, that is you. Now he is working according to his self-interest. He is focusing on his self-interest. He wants to make money. Now the agency problem arises between you and the mechanic, the principal and the agent. The same thing happens even in the business. Okay, so in a limited company, in a private limited company, the shareholders hire the board of directors and managers to take care of the daily activities of the business, because shareholders they'll not be able to take care of the daily operations because they are not specialized, they are not ready, they may not have time to focus more on the day-to-day activities of the business. They just choose board of directors or managers in the annual general body meeting, and they'll ask them to take care of the best interest of the shareholders and the overall business. Now, by doing that, shareholders will become the principals. Okay, they have become the principals. They're principals. Now, shareholders are hiring whom? They're hiring board of directors, or they're selecting board of directors. They'll choose some 5 to 6 individuals who can take care of the operations, the day-to-day activities of the business, or they can run the business on behalf of shareholders. These board of directors will become the agent, the agents. Okay, so they are the agents of the shareholders. So shareholders are the principal and board of directors are the agents. Now, the duty of board of directors is to work according to the best interest of the shareholders. So what is that shareholders are expecting? Ensure the business generates enough of profit to take care of expenses, to take care of outstanding liabilities, to take care of future projects. That is the expectation from the shareholders. Now, it is the duty of board of directors to ensure that the business generates sufficient profit, excess profit, so that the dividend can be distributed to the shareholders, the expenses can be paid to the to the stakeholders, or it can be the business can pay the tax, the business can take care of rest of the activities. If the business is not able to run, if the board of directors are not able to take care of the interest of shareholders, that's when the agency problem arises in the business. For example, in Satyam Computers example, Ramalinga Raju he was supposed to take care of the best interest. He was in the board. So since being a board member, he was supposed to take care of the best interest of shareholders, but he did not do that. What he did window dressing of accounts. He manipulated the accounts, right? So because of that reason, most of the problems have been created for Satyam Computers, and ultimately it was had a lot of problems. So that is called the principal and agent relationship. Let's quickly refresh our memories, like what have we discussed so far. Corporate finance is a broad area of finance that discusses about the sources of funds and the application of funds. Every choice that a business makes has financial consequences, and any decision which touches the finances of a business is a corporate finance. Maximizing the value of shareholders or the stakeholders is the ultimate goal of corporate finance. Stakeholders to the business can be broadly classified into two categories: internal stakeholders and external stakeholders. Corporate finance decisions are irreversible in nature. Agency problem arises when agent fails to act in the best interest of his or her principal. Now let's understand the corporate finance decisions. So how the corporate finance decisions are taken. Generally, corporate finance decisions are taken under three broad categories: capital investments, capital financing, dividend payout. Let's see each one of this one by one. Capital investment decisions. In an ideal world, a business need to accept all the business opportunities that comes in its way. For example, because the business is actually running for opportunities, right? So every business wait for opportunities, and opportunities are, like the real, the real moments for which every business generally waits for. But most of the time, business would not be able to accept all these business opportunities, though they live, they survive, they anticipate business opportunities. Though this statement looks contradictory and looks very, complicated, let me, take some examples and I'll show you why I'm making this statement. Sometimes business required to reject some of the business opportunities, though they are business opportunities. Let us see this example. Let's say a business has four business opportunities. Okay, so project A, B, C, and D. Four business opportunities are, available right now. Each project requires an initial investment of 15 lakhs. Okay, so when we mention minus in capital budgeting techniques, when we discuss about capital budgeting techniques, we mention initial investment in minus because this is the cash outflow. This amount is going from the business. Okay, 15 lakhs. Every project, project A, B, C, and D, all these projects require an initial investment of 15 lakhs. Year 1 onwards, okay, so they'll start generating the cash flows. Year 1, 2, 3, 4, 5, and 6, and so forth. Okay, so year 1, project A generates 3 lakhs. Year 2, project A generates 1 lakh, and year 3, year 4, year 5, year 6, there is no cash flow. Maybe year 7, the business may generate cash flows, but the data is not available. Now, project B. Project B also requires an initial investment of 15 lakhs. Same thing. So project B also in the first year, it will generate 3 lakh. Year 2, it's 1 lakh, and there onwards, there is no cash flow. Project C requires an initial investment of 15 lakhs, but it does not yield any benefit or does not yield any return in year 1, year 2, year 3, year 4, but it yields some returns in year 5 and year 6. That is 3,50,000 year 5 and 3,50,000 in year 6. Now, let's see project D. So what is the initial investment required? For this project also, it requires 15 lakhs initial investment, but there is no cash flow in year 1, year 2, year 3, and year 4, but there is a cash flow from year 5 onwards, year 5 and year 6. Now, if we look at this example, this simple example, what do we gather? What do we understand? Project A, B, C, and D, all these four projects requires an initial investment of 15 lakhs each, but project A and B start yielding returns from year 1 onwards. Okay, so 3 lakh, 1 lakh, 3 lakh, 1 lakh. Okay, so they'll not take any time. Year 1 onwards, they'll start generating returns, but after that, there is no cash flow. Maybe after year 6, they would yield cash flows. There is no data available for this project. But if you look at project C and D carefully, project C requires an initial investment of 15 lakhs. D also requires an initial investment of 15 lakhs, but they are not yielding anything until 5th year. 5th year onwards, project C is generating 3,50,000 and 3,50,000 in year 6. Okay, so now what we understand from this is like when it comes to the priority. Okay, so when it comes to the priority, the order. Okay, so when it comes to the priority, project A and project B are prioritized for investment, and project C and D will be kept on hold because project A and B recovers initial investment early in the early stage of the project. Okay, it is not, though it is not a full recovery of the cash flow, but it recovers recover some of the amounts, right? So out of 15 lakhs, it is recovering 3 lakh, 3 lakhs plus 1 lakh. So 4 lakhs it is recovering. Even project B is recovering 4 lakhs in 2 years time. But if you see project C and D, they're waiting until 5th year to recover the initial investment, which is dangerous. Okay, so this is dangerous for the business, because every business, okay, so every business should recover the investments as early as possible, because the business is always uncertain. Okay, business means uncertain, so uncertainty is another meaning for business. So in an uncertain business world, recovering the initial investment is important, because risk taking protection against the risk is more important than making profit or anticipating abnormal profits in the long run. So project A and B preferred against project C and D, because they are recovering at the initial stage itself. So that is the reason we have mentioned that business should not accept all the business projects. Though the business has got 4 projects, but it should not accept all the 4 projects, because 2 projects are yielding cash flows from year 5 onwards, which is not safe for the business. Okay, so that's a reason capital budgeting techniques play a vital role when it comes to the financial decisions, okay, the investment decisions of the business. There are 4 important capital budgeting techniques used by the corporates, but these capital budgeting techniques are not limited to these 4, but these 4 are traditional and most popular methods used by the corporates. Payback period method, okay, net present value NPV, internal rate of return IRR, break even analysis. Okay, so break even analysis, this is also called as BEP analysis, break even point analysis. So these are the 4 important methods used by corporates, and these are the traditional yet the most demanded, most popular capital budgeting techniques used by the corporates. So let's have a look at each one of this. Let's understand how these methods work. Payback period. Okay, so what is the payback period, payback method? This capital budgeting largely discusses about how quickly the business is able to recover the initial investment. It's all simple. So how quickly the business is able to generate the cash flows, and how quickly the business is able to recover the initial investment. Okay, so to calculate the payback period, we use this equation. Okay, so payback period is equal to initial investment divided by net annual cash inflow. Let's have a look at some of the examples so that it is very clear to you. Yeah, so a business has got 4 projects. Okay, so there are 4 projects available for a business. Each project requires an initial investment of 1 lakh. Okay, so 1 lakh minus means this is the initial investment, cash outflow. Okay, so cash outflow. Cash outflow. Project A yields 30,000 in year 1, 40,000 in year 2, 10,000 in year 3, 20,000 in year 4. Okay, project B 40,000 year 1, yeah, 40,000 year 1, 30,000 year 2, 30,000 year 3, 40,000 year 4. Project C yields 1 lakh in year 1, 50,000 in year 2, 30,000 in year 3, 50,000 in year 4. Okay, so just focus on the cash flows. Project D yields 50,000 in year 1, 50,000 in year 2, 20,000 in year 3, 10,000 in year 4. Okay, so now let us look at this part, the payback period. Okay, so this part. Now, if you see project A, the initial investment was 1 lakh. Okay, so how much time the project took to recover the initial investment? 30,000 plus 40,000 plus 10,000 plus 20,000. Okay, so 30, 40, 70 plus 10, 80, 80 plus 20, 1 lakh. So it took 4 years. Okay, so this requires 4 years to recover the initial investment. That means how quickly the business is recovering the initial investment? Project A is requiring 4 years to recover the initial investment. Now let's see project B. Project B is recovering 40,000, 30,000, 30,000, 40,000. So 40,000 plus 30,000 plus 30,000. So third year, okay, 40,000 plus 30,000, 70,000, 70,000 plus 30,000, 1 lakh. So in third year, project B is recovering the initial investment. Okay. Now, project C, initial investment was 1 lakh, and the first year itself, the project C is recovering 1 lakh. Second year 50,000, third year 30,000, and third year, fourth year 50,000. So first year itself, it is recovering the initial investment. So the payback period was 1 lakh. Sorry, 1 year. Now, project D. Project D, initial investment was 1 lakh. Year 1, 50,000, 50,000, 20,000, 10,000. So in 2 years, the project is recovering 1 lakh. Okay, so it requires 2 years. Now, what we need to understand is how quickly the business is able to recover the initial cost is what we need to understand from payback period. If you look at this example carefully, project C has taken a least time, that is 1 year, to recover the initial investment. Okay, and if you see project A, it has taken 4 years to recover the initial investment. In this case, which project is more safer and which project is more riskier? Right? Project C is more safer and project A is more riskier. Okay, so project C yields recovers initial investment in 1 year. Project A recovers in 4 years. So when it comes to the priority, business should invest in project C and should ignore project A. Okay, so that is called payback period. That's a payback calculation. Now, let's understand the advantages of using payback period method. It is simple to understand. Okay, so it is straightforward because payback period calculation does not involve any complicated mathematics. It is just simple how quickly the business is able to recover the initial investment. So simple to understand, easy to calculate. It is just addition of cash flows until the complete initial investment is recovered. Payback period method allows for the ranking of business projects. So based on the payback period, the time taken to recover the initial cost, so we can rank the business projects and we can prioritize. Payback period stresses more on the cash flows, not on the accounting aspect of the profit. Okay, so what is important? How much cash is required, right? How much of cash is recovered is calculated, and accounting profit is not taken into account. So cash flows are given the importance. Less time consuming. Calculation of payback period is very quicker because there is no complications involved in the calculation of cash flows. You just keep adding cash flows until you recover the initial investment is all we do in project payback period. That's why it is less time consuming. Let's quickly have a look at a simple example in payback calculation so that it will be more clear to you. Raghav Limited is interested in a project requiring an initial investment of 50 lakhs and is anticipating generating of rupees 5 lakhs in year 1, 7 lakhs in year 2, 10 lakhs in year 3 and 14 lakhs in year 4 and 25 lakhs in year 5. From the details given above, calculate the payback period for the project and recommend which project is more feasible for from investment point of view. So we will first, when we need to calculate the payback period, we first need to list the cash flows received for the business. Okay, so let's say for how many years? This is for 5 years. For 5 years, the business is going to generate the cash flow. So first year 0, 1, 2, 3, 4, 5. Why 0? This is the starting of the business. So that is why it is 50 lakhs is minus, it is in the bracket. Okay, so 50 lakhs is in bracket because this is the initial investment. Okay, so now, so initial investment is 50 lakhs and year 1 onwards, year 1 there is no cash flow because this is only cash outflow. Okay, so cash outflow on initial investment. So cash inflow starts from year 1. So 5 lakhs, 7 lakhs, 10 lakhs and 14 lakhs and 25 lakhs. So now to calculate payback period, what we have to do, we have to calculate cumulative cash flows. Okay, so we just keep adding the cash flows. Okay, so we need to add cash flows. So initial investment was 50 lakhs, it was initial investment to do minus. Now year 1, how much is recovered? What is the amount we cash flow? It was 5 lakhs, right? It was 5 lakhs. So 5 lakhs received, recovered. So 50 lakhs was initial investment, 5 lakh recovered first year. So what is the remaining amount? 45 lakhs. So 45 lakhs to be recovered in the remaining cash flows. Now, second year, how much is the cash flow? 7 lakhs. So 45 lakhs minus 7 lakhs, it is going to be 38 lakhs. So 38 lakhs to be recovered from the remaining cash flows. Now, third year, there is another cash flow, 10 lakhs. So 38 lakhs minus 10 lakhs, 28 lakhs. So 28 lakhs to be recovered from the remaining cash flows. From 28 lakhs, fourth year, there is a cash flow of 14 lakhs. Okay, so 14 lakhs to be, recovered. And from 28 lakhs, if you recovered 14 lakhs, what is remaining? 14 lakhs. So 14 lakhs to be recovered from the remaining cash flow. Now, what is the amount to be recovered? What is the balance to be recovered? 14 lakhs. What is the cash flow on fifth year? It is 25 lakhs. Okay, so we need just 14 lakhs to completely recover the initial investment of 50 lakhs. Okay, so we need 14 lakhs, but we have the cash flow of 25 lakhs. So here is the calculation which we need to be very careful. We have to calculate this using the equation which I showed you just now. What is the equation? So payback period, okay, is equal to initial investment divided by net annual cash inflow. Okay, so what we do, first 4 years we have taken because it is already recovered, 4 years plus. So what is the initial investment to be recovered now? It is just 14 lakhs. Okay, so the 14 lakhs divided by net annual cash inflow. What is the cash inflow on fifth year? 25 lakhs. So 25 lakhs. Okay, yeah, so 25 lakhs. So if you just divide 14 lakhs by 25 lakhs, it is going to be 0.56. Okay, so 4 years plus 0.56 is 4.56 years. This is the payback period. Okay, so this project has a payback period of 4.5 years. Considering these cash flows, the project will recover the initial investment in 4.5 years. I hope it is clear to you. Now, let us see the limitations of payback period. Okay, so no capital budgeting technique is free from the limitation. Neither, any technique nor any method is, free from the limitations, right? So every system will have its own benefits or plus and minus. One of the most important limitation of payback period is, this ignores the time value of money, right? So time value of money, one of the most important topic in financial management is time value of money, and payback period eliminates time value of money. Okay, because it stresses more on the cash flows, not on the opportunity cost. Okay, so opportunity cost is one of the most important topic discussed in corporate finance. Okay, so time value of money, the rupee earned today is worth more than the rupee that would be earned tomorrow, right? The rupee invested today is worth more than the rupee that would be invested tomorrow, right? So that aspect, payback period, ignores or eliminates that consideration. The second limitation of payback period is it ignores cash flows after the payback period. Okay, so just to quickly show you this, it actually ignores the cash flows after the payback period. If you see the previous example, we have taken only up to when it was, it was just like, it was 4 years plus what was the amount to be recovered from 25 lakhs, right? So after that, the cash flows are ignored. Only 4.56 years is what we wanted, actually, nothing beyond that. Okay, so if you see the another example which I showed you just now here, so if you see project C recovers initial investment in year 1 itself, but what happens after year 2, year 3, year 4? This is completely, right, it's completely ignored. Okay, this part is completely ignored. Okay, so that is the limitation of payback period. But we need to understand the cash flow. Every cash flow is important, because whether it is now or tomorrow, it is yielding cash flows. Okay, just considering 1 lakh and forgetting the project is not a viable or a feasible thought. Okay, it is not a practical thought in the investment management. So that is the serious limitation of payback period. Okay, and no risk consideration, there is no discussion of risk in this. Okay, so there is no risk discussed, there is no risk element discussed in this payback period. It is just the cash flow we discussed. There is no discount rate discussed, there is no interest rate discussed, there is no opportunity cost discussed, there is no, the percentage of loss or the compound effect of cash flows is discussed. So no risk consideration. So scope for personal bias. Okay, so when two projects yield the same cash flows, for example, in the previous case, you can see project A and B both yield the same cash flows. Okay, so 3 lakh, 1 lakh, 3 lakh, 1 lakh, year 1, year 2, right? So the person who is actually calculating the payback period they may be biased. Okay, he can exhibit his bias. He may choose one among these two projects, though both are similar. He may choose project A against project B, or project B against project A. So there is a scope for personal bias. Which one to choose? The person who is actually deciding, the project manager, who can choose this against this, or project B against project A. So that is the limitation of payback period method. Now let's understand the second important capital budgeting technique, that is net present value. Net present value is the difference between the present value of cash outflow and the present value of cash inflow during the period. And the NPV is the present value of an initial investment expected. The net present value is the present value of an investment's expected cash inflow minus the costs of acquiring an investment. One of the beauty of net present value method is it considers the time value of money and it gives due weightage for the cash flows, the discounted cash flows, the discounted cash inflows, and the discounted cash outflows. The net present value for a given project is calculated by using the equation NPV is equal to summation t is equal to 0, cash flow t divided by 1 plus r power t. So here this is t is equal to 0, this is t is time, so this is discount rate, okay, this is the duration, and NPV is equal to cash flow plus cash flow 1 divided by 1 plus r power 1 plus cash flow divided by 1 plus r power 2 plus cash flow t divided by 1 plus r power t, right? So this is minus because remember initial investment will always be shown in minus or in bracket, right? So initial investment, this is the cash going out and this is coming in, okay, this cash is coming in. So these are the discounted cash flows, okay, so this is the one, this is discounted cash flow for first year and this is the discounted cash flow for second year, okay. So these are the cash coming in and this cash is going out, okay, this is cash is going out. So this is the equation we use to calculate the net present value. So there is a decision criteria based on NPV, how to decide projects based on NPV. If NPV is greater than 0, accept the project. The net present value is greater than 0, accept the project. If the NPV is less than 0, reject the project. If the NPV is equal to 0, accept the project. Okay, so when the present value of cash inflow is greater than present value of cash outflow, NPV is positive and hence the project is acceptable. The present value of cash inflow is equal to the present value of cash outflow. In that case, NPV is 0. That is the reason project is still acceptable. Though this is a decision to be taken based on the circumstances because the present value of cash inflow is equal to the present value of cash outflow. So still the project is accepted because the project is yielding the NPV 0, right? So NPV is 0, so still it can be accepted. The third category, the third criteria, the present value of cash inflow is less than the present value of cash outflow, right? If the NPV is less than 0, right? So if the present value of cash inflow is equal less than present value of cash outflow, that means the cash coming in is lesser than the cash is actually going out. Generally NPV is negative and the criteria to consider this project is to be rejected because the cash outflow is more than the cash inflow. The discounted value of cash outflow is more than the value of discounted cash inflow. So let's understand the advantages of net present value. It is easy to understand, simple, and it considers the time value of money, considers all cash flows, unlike payback period. In payback period, you have seen we consider only those cash flows which are required to recover the initial investment. But in this case, in time value of money, the consideration for time value of money, and we consider all the cash flows during the entire length of the project. And there is a consideration for the risk factor. Now let's have a look at an example how to calculate NPV so that it will give you a clear picture of how to calculate NPV and how it is useful. Hercules Limited is planning to acquire an asset that expects to yield positive cash flows for the next 5 years. Its cost of capital is 10%, which it uses as the discount rate to construct the net present value of the project. The following table shows the cash flows for the period. Okay, so initial investment 0 is
60 lakhs. The project requires an initial investment of 60 lakhs. Year 1 onwards, the project start yielding the cash flows 15 lakhs every year for the next 5 years. Okay, so every year it is yielding 15 lakhs for the next 5 years. Let's calculate NPV, the net present value. So year, these are the years, year 1, 2, 3, 4, 5. For this is for 5 years. The project is going to be receiving cash flow for the 5 years, and the initial investment is 60 lakhs. Every year there is an cash flow of 15 lakhs. Okay, this is just the cash flow, not a discounted cash flow. Remember this. Okay, so these are just the cash flows. So 15 lakhs, these are just the cash flows. Now, what is the discount rate? It is 10%. There is an equation to calculate the present value of money. Okay, so in this case we are going to use the table to calculate the discounted cash flows. You can use either method. You can either go for time and present value equation, or you can go to the table values. Okay, so table values are readily available. You can just directly calculate discount values, these values by using the table. Okay, so you can directly take these values from the table. So one for 10% first year, table value is 0.909, 826, 751, 683. I'll show you this 0.620. Okay, these are the table values. I'll show you this. Okay, so this is the table. Okay, this is called time value of money, the present value table, the present value and future value table. Since we are discounting, remember this, there are two concepts. Okay, one is compounding and discounting. Okay, the one is compounding and discounting. In discounting, we are trying to convert the future value of cash flows into present value. In compounding, what we do, we try to convert the present value of cash flows into the future values. So that is compounding. So discounting and compounding. So in this case, in net present value, when we are calculating net present value, we apply the discounting principle. Discounting is nothing but the present value. We are calculating the present value of all future cash flows. So that's the reason we have to see the present value table. Here it is. Okay, so this is for present value for 10% discount rate for first year. What is the table value? 0.909. Okay, so 909, 826, 751, 683 and 620. So all these values are taken. Okay, so 10%, and this is for 5 years. For each year we have to take. So we have taken those values. I hope it is clear. So we have taken table values, and next what we will do, we will simply multiply the cash flows with the discount factors. For example, 60 lakhs into 1. Why it is 1? Because this is an initial investment. It will be default 1. Okay, so minus 60 lakhs. 15 lakhs into 0.909, 13.63, 650. 826, 15 lakhs. So 15 lakhs, 0.751, 11, 26 to 500. Okay, 15 lakhs into 683, 10 lakhs, 24,500, and 15 lakhs into 0.620, 9 lakhs, 30,000. So 9 lakh 30,000. Now what we have to do, we have to add all these cash flows. Okay, so all these cash flows have to be added. Just add this. Okay, so you will get 3,16,350. Why it is 3,16,350? That means from 60 lakhs, if you reduce all these cash flows, you're going to get 3,16,350 minus value. Okay, so first what you have to do, first you have to add all these cash flows. Okay, once you add, you have to compare these cash flows with the initial investment. What was the initial investment? 60 lakhs. So 60 lakhs was the initial investment. What was the amount recovered? These are the amount, and then the difference was minus 3,16,350. That means the present value of all the cash inflows is lesser than the present value of all the cash outflows. Okay, this is the present value of cash outflow, and these are the present value of cash inflows. So the present value of cash inflow is lesser than the present value of cash outflow, what is the NPV decision criteria? If NPV is greater than 0, accept it. If NPV is less than 0, reject it. So in this case, NPV is less than 0, straight away we reject this project because the NPV, the net present value of all the cash inflows, is negative. So we reject it. This project will be rejected. Rejected. I hope you are clear about why this project is rejected. Now let's have a look at the limitations of net present value. In fact, we have chosen net present value since it has some of the advantages against big payback period, but now NPV method itself has got limitations. So what are the limitations? Discount rates are not stable. Okay, so these discount rates are not stable. If you see this example, we have taken 10%. Okay, this is one of the most complicated decisions in corporate finance, because on what basis we have chosen 10%? On what basis? Generally, these discount rates will be based on the risk-free rates. Okay, so there is something called risk-free rate. Okay, so this is a risk-free rate. This is the rate at which we generally wish to invest our money. For example, let us say I have 10,000 rupees. I expect minimum of 7% or 6% of return every year. Let us say if I need to invest that money in a bank, if I need to deposit that money in a bank, I expect 6 to 7% of return. That means every year I need to get 6% or 7% of return so that I can protect the value of my money. Because technically, what it indicates, every year your money will lose value. Okay, how much? 6 to 7%, for example. Okay, so that much of value has been depreciated in your money. So you have to protect the value of your money. How? By investing your money at minimum of risk-free rate. So that's why we keep our money in banks we keep our money in banks, we keep our money in chits, we keep our money in investments, we keep our money in shares. So we do all that. So based on our risk appetite, we invest our money in financial instruments. So the risk-free rate. So this 10%, how this 10% is chosen is the complicated decision, and that is a multifaceted problem to be solved in corporate finance. So consideration of 10% is a questionable item. Okay, so on what basis 10% is taken into account? Assumptions of future interest rate may be subject to personal bias. Okay, and subject to personal bias means this discount rate is dependent on who is valuing the project. Okay, the person who is valuing the project may assign 8%. Okay, 8% or 10% or 9% or 7% or whatever. So that is based on his personal bias. Suitable only ideal capital market. Okay, so this method is suitable only in ideal capital markets where the discount rates are standard. Okay, which will remain the same for at least for a definite period of time. But in reality, it is very difficult to imagine that the discount rates will remain stable. IRR of project is ignored. The internal rate of return of project is ignored, which we are going to discuss now. Internal rate of return is the rate at which the present value of cash is equal to the present value of cash inflow. Okay, so this is a simple definition of internal rate of return. The rate at which the present value of cash inflow is equal to the present value of cash outflow. You need to be careful when you're calculating IRR, because most of the time, we see this confusion between IRR and NPVs. Most of the time, though they look little similar. Okay, so in NPV, what we do, we calculate the cash flows, the discounted cash flows, the present value of all the discounted cash flows and the present value of all the discounted cash outflows. The cash inflows and the cash outflows. So we calculate the cash flows. We see the difference. If the NPV is 0, if the NPV is more than 0, accept. If NPV is less than 0, reject. But here in internal rate of return, what we are doing, we are trying to calculate the discount rate. Okay, so we are not calculating the cash flow, we are calculating the discount rate at which the present value of cash inflow and the present value of cash outflow is equal. So that is the reason we call this is most of the time this is also called as hurdle rate. Okay, so the discount rate is also called as hurdle rate or discount rate or whatever. So we generally call these two terms, so hurdle rate or discount rate. So this rate, so we are calculating the rate here. Okay, so we are calculating the discount rate. Okay, we are calculating the discount rate. So generally in internal rate of return in this method we use trial and error method. Okay, so when it comes to the manual process we use trial and error method. Trial and error method to calculate internal rate of return. So these are the steps you can see on the screen. Select two discount rates of calculation of NPV, calculate net present value using discount rates chosen, determine IRR and interpret. I'll show you one example how trial and error is done using two discount rates. Let's take an example. Let us assume that your friend suggests you to invest on project Alpha, in which you can deploy 10 lakhs today, and from next year onwards the project would start yielding rewards without additional investments. Below is the summary of investments made and cash flows expected in future. So this project, you can see the initial investment is 10 lakhs. Year 1 onwards there is a cash flows, right? There is a cash flow. Year 1 2 lakhs, year 2 3 lakhs, year 3 3 lakhs, year 4 3.5 lakhs, year 5 3.5 lakhs. Total cash flows are 15 lakhs. So it is given in a matter of 5 years the business is generating 15 lakhs cash flows and the initial investment is 10 lakhs. Okay, so it is already given, so there is no need to calculate NPV. Okay, so NPV is already there. Okay, so discounted, the cash flows are already given. Now what we are going to calculate is very simple. So this is 10 lakhs. Okay, this is the initial investment, right? Initial investment, and this is the total of cash flows. At what rate? Okay, at what rate the present value of cash inflow is equal to the present value of cash outflow. Okay, so we are trying to calculate the rate at which this is going to be equal. Okay, so 10 lakhs initial investment, 15 lakh cash flows. Okay, at what rate this will become equal? So that is what we are going to calculate. So generally we assume two discount rates to arrive at internal rate of return, because we don't know what is the discount rate. That is what we are actually trying to calculate now. So when we don't know the discount rate at which these cash flows, the cash flow, the today's initial investment and the total cash flows of the project are going to be equal, we don't know the discount rate. So what we do, based on the average discount rate, we take two discount rates. Okay, so we try two discount rates. We take two discount rates which are on average. Okay, so which will come on average, so generally that are used in the industry. So let's say we will first try at 10% and then we will try for 12%, or we will try for first at 8% and then we will try at 12%. So we do that in this method. Okay, so you can see first we will try at 8%. Okay, so first we try at 8% discount rate. Okay, so what we do, we apply the same principle. Okay, initial investment 10 lakhs. Okay, year 1 onwards there is a cash flow, right? 2 lakhs, 3 lakhs, 3 lakhs, 3.5 lakhs, 3.5 lakhs. So every year we apply 8% discount rate. You can do one thing, you can apply this equation, present value is equal to future value divided by 1 plus r power n, or you can straight away go to the table values and you can find out. Okay, so the table values, you can just take it and you can just populate it here and simply multiply these discount rates with the cash flows. That's all. Okay, you will get these results. Okay, so 10 lakhs. So for first year, if you apply 8% discount rate, if you bring the table value, it will be 1,85,185. Second year, it will be 2,257,202, and third year onwards, so on and so forth. Okay, so just calculate this, and the total cash flows will be 11 lakhs 76,001. Now we need to question ourselves, is this equal to the initial investment? What was the initial investment? It was 10 lakhs. What is that we have got? The total cash flows at 8%. Okay, it is 11 lakhs 76,001 rupee, right? So now the total cash flows are not equal to the initial investment. Now you see, this is very important. When you have 8%, when you are 8%, you're taking 8%, your NPV is 11,76,001 rupee. Now you need to be very careful. If you increase this discount rate, remember this will come down. Okay, so if you increase 8% to 10% or 12% or 13%, this will come down. Technically, we need to bring this down because our initial investment was 10 lakhs. Now we are getting NPV of 11 lakh 76,001 rupees. So it has to be 10 lakhs. So if I need to make it 10 lakh, what I can do? I can simply increase the discount rate. That's a logic. Okay, that's a logic we need to apply. So if you increase the discount rate, let's say if you will try with 12% or 13%, this will come down. How much it should come down? Only when you calculate, you will be able to understand this part. Okay, so let's see, let's try this with 13.92%, or if you want to refer table, so you can try 14%. Okay, so if you try 14%, what will, you can just populate this 14% discount rates for 5 years, then multiply, then you will get 10 lakhs. Okay, if you try with precise 14%, this would go up, okay, little more, maybe 10 lakh 20,000 or 30,000. We don't want that amount, we want exact amount, right? So that's why 10 lakhs. So we will try with 13.92%. So this is what you need to understand. 13.92% is the rate at which the present value of cash inflow is equal to the present value of cash outflow. This is what we wanted. Okay, so the present value of cash outflow, the cash inflow is equal to 10 lakhs now. You see this. Okay, so now what is the discount rate? This is the discount rate at which the present value of cash inflow is equal to the present value of cash outflow. So this looks very hard method because this is a manual method. Thankfully, there are a lot of online calculators available. You can just try internal rate of return calculator, even for NPV, even for payback period. So you can use online calculators. If you really want to understand the method, you have to try this manual method. If you don't want to go through this lengthy process, you can straight away go to the online calculators for NPV and IRR, and for payback period, you can just derive these values. Okay, so that is internal rate of return. Now let's understand the last method in capital budgeting technique in this session is break-even analysis. Okay, so one of the most popular method in capital budgeting technique is break-even analysis. So most of the business firms will be interested in calculating break-even point because this is the point at which the business neither makes profit nor the loss. generally when the business is started, the break-even point, calculating the reaching break-even point will be one of the dreams of a business, because only when they reach break-even point, they can, enjoy the next zone, that is making profits. Okay, so that is the reason, businesses generally are interested in calculating break-even point. So there are some of the important terminologies that are used in break-even analysis: fixed cost, variable cost, revenue, contribution margin, right? So these are the terms commonly used in break-even analysis. So fixed cost is a cost or an expense that does not change with change in the level of output. So this fixed cost will remains the same for the business irrespective of the level of output or the quantity produced. Variable cost is nothing but the costs that are incurred in proportion to the volume of output. Okay, this will keep changing. This cost would vary, it would go up or it will go down. The revenue is the total amount of business that a business generates during the period. The contribution margin is nothing but it is the sales minus variable cost. So this is a very important diagram. So you need to understand this diagram, because this is how the break-even point is calculated. Okay, so this is OX axis, this is OY axis. OX axis exhibits the units sold during a period, and OY is representing cost, the cost incurred by the business. Okay, so yes, this is the fixed cost. Okay, SF is the fixed cost line. So this cost will remain the same irrespective of the level of output. Okay, so this business will have this cost irrespective of the level of output, whether the company is performing or not performing or whatever. So this cost will remains the same for the business. So S and F will be the same. Now you see there is a line going from O onwards, right? So OV, this OV is nothing but this is the variable cost line. Okay, so the variable cost line is beginning from 0, because the variable cost will change based on the number of the quantity produced. So that will keep changing. So this will keep raising, because this will, since the units sold will be raising, so variable cost will keep raising, but fixed cost remains the same irrespective of the level of output. Now you can see there is one more red line which starts from S. Okay, so ST, this is the total cost line. How this is arrived: total fixed cost, okay, and total variable cost. Okay, if you put together, this will be the total cost line. Okay, sorry, this is the red line is total cost line. So S and T is the total cost line. Now you see an important line which is starting from 0, OS, right? OS. This is the sales line. Why it is starting from 0? Because the sales will begin from the day 1. So from the day 1, the sales has been started. So it is started and it is raising. Now you see there is a point at which the total cost line is intersecting with the total sales line. Okay, so this is the point at which the total revenue of the business is equal to the total cost incurred by the business. So this is the point at which there will be no profit, no loss for a business. Okay, up to this point, whatever the business incurs will be the loss. This will be the loss zone. You can see this is the loss zone, and beyond this point is the profit. Okay, so the profit, and you can carefully observe this, the profit proportion will keep increasing. Okay, this will be go increasing to certain levels. Okay, this will be the profit zone. So this is the point that every company dream for, because this is the point at which they break the loss zone and they enter the profit levels. So this is the calculation of break-even point, no profit, no loss zone. Now let's have a look at an example to understand this topic better. Vijay Limited is a producer of electronic chips for laptops. The cost of the company includes the cost of rent for buildings, salaries, taxes, which adds up to 12 lakhs. The variable cost associated with the production of each electronic chip is 10 per unit. The chips are sold with the premium price of 60. Determine the break-even point or the no profit, no loss zone for the company. Simple yet straightforward. So now we have fixed cost given 12 lakhs, variable cost per unit is 10, selling price is 60. So now how we calculate the break-even point? We calculate break-even quantity now in this case, because this is the quantity that we need to identify for no profit, no loss zone in this example. So break-even quantity is equal to fixed cost divided by sales price per unit minus variable cost per unit. This is the equation. We use this. So this is the equation. So 12 lakhs is the fixed cost and sales price per unit is 60 and variable cost per unit is 10. So break-even quantity is 24,000 units. Okay, what it means? 24,000 units to be produced to reach break-even quantity. That is a quantity at which there will be no profit, no loss. I hope it is clear. Now let's understand one of the most important topic in corporate finance, that is capital structure. So what is capital structure? Capital structure is nothing but it's a combination of various sources of funds. For example, let's say a business is running and it is requiring funds for various reasons. It may be to daily tactical activities or it may be to take care of its long term the goals of the business. So it requires money. Now when business requires money, the business may borrow from various sources. It may be borrowing from debt funds, or it may be borrowing from equity sources, or maybe it may be preference capital, or it may be considering the retained earnings, because there is something called retained earnings. For example, companies will generate profit year on year sometime. So what they do, instead of distributing everything to the equity shareholders and the others, so they retain one portion of the profit and they'll just retain with them for future requirements. It may be to emergency or it may be to take care of the future projects. So in that case, the retained earnings will also be a part of capital structure. When you say the entire capital of the company is a bucket, okay, so if you consider this is the bucket of all the cash, all the sources of funds, so what is the proportion of each source and what is the proportion of the source from which the company is borrowing or the business is borrowing? Let's say equity, debt and retained earnings are part of the capital structure of a company. So what is the proportion of equity in the capital structure? What is the proportion of debt in the capital structure? Or what is the proportion of retained earnings in the capital structure? Sometimes companies will make a combination of both. Let's say 30% of the funds will be from the debt sources and 70% of the funds from equity sources, or it may be other way around. Equity plus equity will be from 30% of equity or 70% of debt. Okay, it depends on the company. So depending on company, this will be different. Now let's understand. Let's say there are two components. Okay, there is a debt capital, there is an equity capital. So what is the advantage of having debt capital in the business? So what are the advantages? Lower interest rates. Let's say a business is funded with debt capital, so the interest will be lower. Let's say there are 6% of interest paid on the loans, so 6%. And what if the same amount is received from the equity? Let's say, what is the interest rate, what is the earnings, what is the return expected from equity? It would be more than the debt rate, right? So it will be, equity will be more, expectation will be more in case of equity. Short-term needs. So debt funds are more suitable for taking care of the short-term needs. Tax advantages are there. If the business is funded with debt capital, it will be there will be tax advantage, because this you need to remember, interest paid on the loan is tax deductible. Okay, interest paid on loans is tax deductible. Okay, very important thing. So that is one of the reasons why some companies will go for debt capital rather going for equity. Simple loan repayment. If it is a debt capital, the repayment schedule will be simple and straightforward. There will be no excess, no additional expectations. Once the repayment schedule is decided, and that is what the company is going to repay every month or year or whatever, so on the regular intervals, so that will be decided, so business can have a clear idea of what is to be paid for the next month or the next year. So what are the limitations of having debt in the capital structure? Okay, so what is the minus, what are the limitations, what are the cons of having debt capital in the capital structure? Repayment risk. Okay, so when it comes to the debt, this has to be repaid. Okay, debt means loan. Okay, so the borrower will be obligated to pay this back to the lender. So a repayment risk is always there, irrespective of your level of profit, the margins you're doing. So repayment has to happen. Bankruptcy risk. If something goes wrong in the business and there is a situation of liquidating the business, the the lenders, the debt holders should be paid first, which we will be discussing in a short time. So I'll be explaining how risky it is for the debt holder, for example, for how safe it is for the debt holder. So in case of debt holders, so debt holders will be paid first if something goes wrong in the business. So the business has to pay the debt holders first, and then the business need to take care of the remaining the lenders. Impact on the credit rating. Okay, when the business is unable to pay the obligations on time, the credit rating of the business will go down. So that is another risk for a business. Collaterals. If there is no collateral for the business, it is too difficult to raise funds through the debt funds. Generally, the debt capital is suitable under the following circumstances. Ready to make regular payments. When the business is ready to make the regular cash flow payments, in that cases the debt capital is suitable. If the credit scoring of the company is good, they can borrow money in the market, because the market will give the loans at affordable rates. If the collaterals, if the business possesses collaterals, then they can go to debt capital. Now let us understand what are the benefits of funding a project with equity capital. Long-term orientation, because equity capital is long-term oriented source of fund. Okay, so this is not given for the short-term requirements, this is not given for operational activities, this is given for the long-term requirements of the business. The risk sharing and added value, because the shareholders share the risk of business to the extent or to the proportion of shares held by them. No regular payment to investors. Companies need not pay the regular coupon payment or interest payment to the investors. So only when there is a profit in the business, the company will pay the dividend. Otherwise, there will be no dividend, or there will be no repayment. There will be no regular payment of dividend. Then what are the limitations of equity capital? Share profit. Equity shareholders will have rights to get a share in the profit of the company, and they'll be the owners of the company to the proportion of shares held by them. And there will be a potential conflict, because there will be conflict, there will be chances of conflict with the shareholders, directors, and the other stakeholders of the business. And the last limitation of the equity is higher cost. Okay, the equity comes with higher return expectations. So the business may not be able to pay that much of cost because it is higher, because they're going to assume higher risk compared to the debt funds. So they definitely expect higher returns. Equity capital is suitable under the following circumstances. So when the credit worthiness of a business is an issue, okay, so in that cases, the companies generally go for equity. When the business is ready to share the profit and control on the business, they'll go for equity funds. The company is ready to share the profit and they're ready to share the control. When the business is not confident of generating profits, when the business is uncertain, they'll go for equity because they don't want to take the risk of borrowing from someone and be under the obligation to pay the outstanding irrespective of the level of business operations, success of business operations. Ready to share the decision making control with the equity partners. Okay, when the business is ready to share the control over the decision making aspects of the business, they'll go for equity funds. So now we will focus more on the factors influencing the capital structure decisions. So on what basis companies choose a particular source, whether it is a debt or equity, on what basis they choose. The factors influencing the capital structure decision, can be broadly classified into three categories: economic factors, industry factors, and company specific factors. Okay, so now let us first understand what are the economic factors, economic specific factors. Nature of the business. Okay, so the nature of the business will have bearing on the capital structure of the business. For example, if the business is, FMCG, okay, so FMCG, the cash conversion cycle will be the quicker. Okay, so if the cash conversion cycle is quicker, they can go for, the debt. Okay, when they have the problem with cash conversion cycle, they have longer cash conversion cycle, so then they can go for equity, because equity capital is important when it when the business is oriented towards the long run. Okay, so they cannot do the things in a matter of fortnight, or they will not be able to do anything in the matter of 1 month. They take unusual time, they take longer time to convert their cash back into cash. Okay, so cash, raw materials, finished goods, inventory, and then cash. So stock market, when the company is listed with the stock market, generally they tend to have equity orientation because they have access to equity capital, so they prefer to go for equity rather going to the debt capital. Taxation, when it comes to taxation, as I said in the previous slides, so interest paid on the loans will be tax deductible. Okay, so there is a tax advantage linked to the debt source of capital. So when the company is preferring to enjoy the tax benefit, they go for the debt capital. If no, they'll go for equity. A rate of interest. Okay, so as I said, the rate of interest for debt will be comparatively lesser than the rate of interest, that rewards you are supposed to pay for equity holders. So in that case, the companies will go for the debt. If they're okay to pay higher rewards to the shareholders, they'll go to equity. Credit policy. Okay, so what is credit policy? What is the credit terms given to the customers? Okay, so sometimes the companies are very liberal. Okay, there is something called net 30. Okay, there is something called net 60, net 90. Okay, so what is this? This is nothing but this is the time given to the the debtors. Okay, so debtors are cleared in 30 days, 60 days, or 90 days. Let's say the FMCG company is giving products to the seller. Okay, they're allowing this the shop, the middlemen, to pay within 30 days or 60 days or 90 days. Okay, so 30 days is the given time, so 60 days, within 60 days they can pay, within 90 days they need to pay. Okay, so this is the credit policy. So this, they're giving the credit policy, net 30, net 60, net 90. So they're liberal. Some companies will go for net 90, net 60. Within today they're buying the products, within 90 days they have to pay the money back. Okay, some companies 60 days they'll give, some companies will give 30 days. It depends on the business. Seasonality. What is seasonality? If the business is seasonal, okay, so they'll go to, for example, in the rainy season, they produce woolen blankets or whatever. Okay, in the winter season, so they'll go for the debt funds. Okay, because their business is seasonal. After the season, they won't be having any business, so they're very seasonal in nature. So they'll go for debt capital. They'll ignore equity capital. Competition is another factor which decides the capital structure. Okay, so some companies understand that the competition level. If the competition is too high, they'll go for equity because the business is uncertain because of competition. So if they go for equity, they need not bother because the risk is shared between the shareholders. And if the competition is lesser or it is comparatively manageable, they'll go to the debt funds. Life cycle of the industry is another factor which actually having bearing on the the capital structure. And the age and size of the company. If the company is younger company, they'll go for, if the company is younger and small in size, if they're ambitious, they'll go for equity. Else, if the company is at the saturation level, they'll go to the debt. Okay, the form, the age of the company and the size of the company matters a lot. Okay, so if the company is younger and they're very ambitious, they prefer, because they're ambitious, they'll go to they'll go to debt capital because they're ambitious, they're confident of earning money. Okay, so they'll go to that. When the business is younger, they're not sure of earning. Okay, they're actually thinking about whether we are really able to make mark in the market, they'll go to equity because they understand the business is uncertain, they don't want to take the risk. Okay, so they prefer equity. Older companies will generally go to equity again. Okay, older companies, while they'll go to equity because they're in the saturation level, they know the business is going to saturate and they're confident that the risk is higher, they'll not go for equity funds, they prefer to go for equity because in equity the risk is shared. The form of the company, okay, it depends on the nature of the company. If it is a single owner company, it is a sole trading company, they'll have their own preferences. If they have partnerships, they'll have their own preferences. If they joint a company, they'll have their own preferences. Stability of the earnings, if the earnings are stable, they'll go to equity, they'll go to debt because they're confident that they're able to generate the revenue, right? If the earnings are not stable, they'll go to equity because they are not sure of making returns. If their credit standing, if the company's credit standing is good, they'll go to debt. If their credit standing is in question mark, they'll go to equity. Again, the management's philosophy, if the management is not interested in sharing the ownership and control on the business, they'll go to debt funds. If the company is open, the management's approach is open and they like ideas from all over, they like they want to give control, they want to give stake to the investors, they'll go to equity. So these are the aspects which generally influence the capital structure decisions. Now the third important decision is the dividend decision. Okay, so paying dividend, generally when the shareholder invest some money in the company, there are two expectations. Okay, so one, when the amount is invested in the company, when the person so invest money in the company, they expect two things. One, it is dividend. The second thing is capital gain. Capital gain. Okay, so some companies give both. Some companies give dividend. Okay, so it is important. Okay, every investment in equity will have these two benefits. But in some cases, some companies pay dividend and some companies don't pay dividend every year. Okay, though dividend is an expectation of an investor. For example, if I deposit 10,000 rupee in a bank, I expect 7% or 8% of interest to be given to me every year. If the same amount is invested in equity market, I expect 10 or 12% of return to be given to me every year. Okay, the 12%, what I say 12% is nothing but it is a expectation. Okay, not sure, expectation. And if bank is giving 7%, that is again an expectation. So these two things. So when it is invested in the company, they may give dividend. That dividend is nothing but this expected amount. This percentage of amount is coming. That means maybe more or less it will be my expectation from the company. And what is the capital gain? Let us say, um, yeah, I have invested 100 rupee in a company. First year, the company is giving me the dividend of 10 rupee. Okay, so what is my amount? So 10 rupee I'm receiving. So total amount is 1110. Okay, so I receive this amount. Okay, so 100. So 100 rupees I keep with the company, and the remaining 10 rupee I take it off. I'll enjoy this. Okay, this 100 rupees is again invested. Next year again, if it is 10%, then 10 rupee. Okay, plus 10 rupee. So this is the dividend part. Let us say I don't want to take this 10% from the company. I want to keep it. Okay, 100 plus first year 10 rupee plus second year 10 rupee. Okay, so 120 rupees will be with the company, and this is given to the shareholder when he liquidate his stake with the company. So that is called capital gain. Okay, so that is a capital gain. When you realize your stake, you will get that amount. Generally, some companies pay the dividend, some companies won't pay. There are multiple reasons for the same. Some companies pay dividend because they're concerned about the public. Because let us say investor invested 1000 rupees in the business. Next year, it is not giving any yield. So what happens? The perception of the investor will be, it will be affected. For example, the investor would think that, what happened? I've invested 1000 rupees last year, no return this year. What happened to my money? What happened to the business? What is happening in the business? So they'll be concerned. So just to avoid these concerns, business every year declare a dividend for the equity shareholders. Okay, so by declaring dividend, they give confidence to their investors, just that we are doing a good job in the market, we are able to generate money out of your money. So that is the confidence they are giving to the shareholders. In some cases, companies don't pay dividend. For example, in many cases, Apple don't pay their dividend. Okay, I'm not saying they never pay dividend, but they prefer not to pay dividend on regular intervals, like a frequent intervals, like year on year or quarterly on quarter, because there is two things. One, by paying dividend, you can keep your investors happy. That is one part. But the second thing is, like, if business keep distributing the profit among the shareholders, what if there is a good investment opportunity for a business? When there is an opportunity, if there is no money with the company to invest in that particular business, so business will suffer, business will lose those precious business opportunities. So some companies retain these dividends and they reinvest. Okay, so this is called reinvestment. Reinvestment, they reinvest this money in the business, and they'll earn more returns, and they'll satisfy the needs of their investors. Okay, so that is the reason some companies don't pay dividend, because they want to reinvest that money in profitable business opportunities. When there is no profitable business opportunity that is existing, and the business has no such opportunities, what they do, they simply distribute dividends. Sometimes you need to understand when the company is regularly distributing dividend, it doesn't mean that the company is doing great. Okay, they just wanted to keep investors happy. That's why they are doing this. In another case, if the company is not giving, the dividend at all, don't be happy. The company may be in problem, or the company may not be having money to pay you, right? So the company must have taken your money and invested in a business project. The money must have been freezed over there. So the business must have not got any money to give you. So that is also a risk. So it is not right or wrong, but business works according to their own strategy. So they definitely keep all these things in their mind. So considering, what if I don't pay dividend and what if I pay dividend? So they know the consequences of both. So they keep the decisions on track. So that is about the dividend decisions. So one of the most important topic in this session is how secured are you? Okay, so when I said in business things are uncertain, okay, nothing is looks safe in the virtually nothing is safe in the business, because business is something that uncertain. We replace the word business with uncertain most of the time. Why? Because business always deal with uncertainties. Business always foresee the future. Okay, so they anticipate, they expect, they dream of making profit, they dream of generating returns, they dream of creating value. So now let us say in a business there are multiple investors, right? There are debenture holders, there are debt holders, there are equity holders, there are preference holders, right? So how secure are their investments in the business? This is very important, because when we say the business is uncertain, if something goes wrong, whose money will be given first? Okay, let's see that with a simple example which will give you a clear idea of who is safe in the business at what proportions. This is a flight. Okay, assume that this is a costly flight, and this has got four class of seating arrangements. One is first class, business class, economic class, and coach plus. Okay, so let's assume this flight is flying on the sky. Okay, and something goes wrong. Okay, you remember this flight has got only one exit door. Okay, so this is the only exit door. There is no other door for passengers to escape and save themselves. Okay, it may not be completely true in the real life, but I request you to assume, because I'm going to explain something which is very important. So this is the only exit door. If something goes wrong, who will be saved first based on the priority? Because these people are sitting very close to the door. These people will be helped to exit first, because if the crew allow these people to exit first, there will be there is a rush, and there will be panic, and there will be chance of people losing their lives just because they are in panic. Okay, just to quickly allow them to exit, the crew would allow the first class people to exit first from the from the flight. Once these first class people are released, these people are allowed to exit the flight first, the next level of people who will be allowed to exit the flight will be the business class seat people, and next will be economic class, and then the coach plus, so that all these people are allowed to exit the flight based on the priority. What is the priority here? The priority is only the thing is that if first class people are allowed first, the second class people, the business class people can be allowed next. Okay, so that is a priority. So that's how people will be saved when it will be something, something goes wrong in the flight and it is about to take off, right? So it is about to burst or something. Now this is the flight was flying high on the sky, something goes wrong, landed. Okay, so immediately after the landing, the first class people allowed to exit first, then business class, and then economy class, and then coach plus people are allowed if the time permits them. In this case, remember, first class people are safer compared to business class, and business class people are safer compared to economic class, and economic class people are safer compared to coach plus. And who is serving the maximum risk when it goes something wrong? Coach plus passengers, right? And who is more safer compared to the coach plus? First class people. Okay, the same holds true when it comes to the business as well. Okay, let's say this flight is a company. Okay, this flight is a company and it is flying high on the sky, and the company is doing really good, and unfortunate business is uncertain, something goes wrong, and who will be saved first in the company? It will be the loan holders. Okay, those who have given loans will be allowed first to exit the business. That means they will be given, in case of liquidation of the business, the loan holders will be returned their funds and then they'll exit immediately. Okay, so in the liquidation, if something remains, okay, the remaining amount will be distributed among the bond holders. So those people will be saved next after loan holders, and then preference equity holders will be given priority. If something left with the company in terms of assets or cash or any infrastructure, so any assets, so they'll be given first. The preference will be given to the preference equity shareholders. After paying all these people, loan holders, bond holders, and preference holders, if something is remaining in the business in case of liquidation, the amount will be given to the equity shareholders. So what you need to understand, the equity shareholders assume highest risk in the business, and the loan holders will assume the lowest risk in the business. Okay, so if something goes wrong, equity shareholders will have a lot of risk, and loan holders will have lesser risk. Okay, so this is the obligation for the company to pay off loan holders first, and bond holders next, and preference holders next, and equity holders. If there is nothing left over, there will be nothing to be paid to the equity shareholders, because the very basic nature of the equity is that the equity shareholders are the owners of the company to the proportion of shares held by them. So that is how the equity shareholders run the risk in business, and the loan holders enjoy that risk, the lesser risk in the business. Remember, for enjoying this, okay, so they'll be given a highest return when the company makes profit. Okay, I'm just writing an example. This is not a true amount. Okay, so these people will be given 12 to 14% of return. Okay, and these people will be given 6 to 7% of return. Okay, so these people, just because these people are assuming highest risk, they're given highest return, and these people are assuming lowest risk, the lowest return. The mathematics is quite simple. Okay, I hope you enjoyed this example. So this is how the investors are secured in the business. Quick recap: accepting all the business opportunities is not a wise decision in business. Payback period method discusses about how quickly a business can recover the initial investments. Net present value is the difference, the present value of cash outflow and the present value of cash inflow. Internal rate of return is the rate at which the present value of cash outflow is equal to the present value of cash outflow. The break-even point is the zone at which the total cost of the business is equal to the total revenue. Capital structure is a collection of various sources of funds for a business. So now let us discuss about one of the most frequently discussed topic in corporate finance, especially in investment banking. So these are the most commonly discussed topics all over the world. So when it comes to business, so the merger and acquisitions are recently discussed, and they have been given a lot of importance nowadays, because the business firms have been embracing mergers and acquisitions for various reasons. So in this section, let us understand, so what are the reasons why merger and acquisition is inevitable or important or necessary for a business. Okay, so before we understand the detailed aspects of mergers and acquisitions, let us quickly understand, so what is merger is all about. What is merger? Merger, before we discuss about what is merger, I want you to go through these four important terminologies, or four important or strange terminologies that I've mentioned here. So you can see 2 plus 2 is equal to 5. Big fish eating small fish. Enemies become friends and friends become a single family. Two different flags unifying to raise a new flag. It looks very strange and the statements are looks very odd, but I'll promise you that after the completion of this particular section you will definitely find answers to why we have mentioned 2 plus 2 is equal to 5 and why big fish eating small fish, why it is mentioned here in this context. Okay, so let's move on first to merger. So what is merger? Merger is a process in which two or more business entities come together to form a new entity. In this process, both business entities cease to exist. Okay, so that's a definition of merger. So in merger, what happens? So two different individuals or two different companies come together to form a new company. Let's say there are two companies, right? So company A is a individual entity. Okay, so this is a company B is a separate entity. So these two companies will come together to form a new entity called C. Okay, so in this process, what happens? A plus B both will lose their existence and C will be formed. In this process, both A plus A and B companies will lose their existence and C will gain existence and that will continue to run. And A and B will become history. Now, why companies generally merge? So what is the reason why companies come together and they merge? What are the benefits and what are the reasons why they merge? Generally, companies merge because of synergy benefits. Okay, so this is one of the most important term in corporate finance. Synergy. Okay, so synergy benefit. What is synergy? The performance of combined entity will be better than the performance of separate entities. See in this example, in the previous example, so the performance of A and performance of B, when they perform individually, it will be different. And when they come together, the performance of this combined entity will be different. So that is the reason you have seen that 2 plus 2 is equal to 5. Let's say the performance of company A is 2, okay, and the performance of company B is also 2. But when company called C is formed, the performance of company is 5. And this is nothing but this is the synergy benefit. Okay, so with the performance of combined entity will be better than the performance of individual entities. And that is the reason, we have mentioned that 2 plus 2 is equal to 5. And when the companies come together, when the merger happened, these are the benefits they gain, like market reach. When the companies come together, they can reach the marketplaces of each company. For example, company A and company B. Company A is strong in Asia. Company B is strong in Europe. So when they come together, company B can have access to company A's market, and company A can have access to company B. So they can perform and they can access the market of each other. Reduced cost. When the companies come together, the cost of operations will drastically come down because the performance of combined entity will be better than the performance of individual entities. The competition will be eliminated. For example, let's say company A and company B are competitor in the same market, okay, in the same FMCG market. Let's assume that they are into FMCG. And let us say there are other companies like company P, okay, company T, small companies. Now, when company A and company B come together, and those two companies are the market leaders in this FMCG segment, and when they come together, there will be no major competition. Okay, so they can create a kind of control in the in the marketplace. They can capture the entire majority of the market, and they can rule the market for a definite period of time or maybe indefinite period of time, because the company P and company D or whatever, so they're very small, they're not strong enough to compete with company B and company A. But when company A and company B come together and they form a company called company C, right? Company C. So company C is much bigger than company B, company A and company B and companies P and company D. So the performance of this company will be better than the performance of company A, B, P, D individually. Okay, so they eliminate the competition this way. Now the growth. Some companies merge with some other companies because of growth requirements. When they really want to grow in the business, they go to the merger. Increase supply. Okay, so when they come together, the supply will be the higher the supply to the market. Let's quickly have a look at some of the examples for merger and acquisitions. Vodafone Idea merger, Flipkart's acquisition of eBay India, Tata and Bharti Airtel, Disney acquired entertainment assets of Fox, Verizon Yahoo deal, Google buying HTC's smartphone business, Cisco acquired Broadsoft, Johnson & Johnson acquisition of, Acleon. So these are some of the examples for mergers and acquisitions. Let's see the example for merger and acquisition, the example for acquisition separately, but these are the common examples for the merger and acquisitions. And we will discuss the examples when it comes to the specifics of merger. Now let us understand the classification of merger. So what is the classification? How the mergers are classified? Basically, the merger is classified into three broad categories: horizontal merger, vertical merger, and conglomerate merger. Let's understand each one of this one by one. Horizontal merger. So what is horizontal merger? In horizontal merger, two business entities operate within the same industry yet competitors to each other. Okay. For example, Amazon and Flipkart are into e-commerce business. Okay. So they're in the same business, the same industry, e-commerce, and they're competitor to each other. In Indian market conditions, environment, they're competitor to each other. Let us assume that, Amazon wants to acquire Flipkart, or the Flipkart wants to merge with Amazon. Okay, that is called, the horizontal merger. In reality, it may not happen, but I'm just giving an example that, when companies in the same industry, they come together to form a new entity, that is called horizontal merger. The best example for horizontal merger of Bank of Madura with ICICI Bank in 2000, merger of Centurion Bank with HDFC Bank. You can carefully observe this. The bank which is merging with ICICI Bank, right? So it is shown small compared to ICICI Bank. Same here, Centurion Bank is shown smaller than HDFC Bank. There is a reason for the same. For example, when it comes to ICICI Bank, when the companies come together, according to the definition we discussed just now, merger is something that, when both entity A and entity B will come together to form a entity C, in that case, both the entities will cease to exist and the new entity will continue to exist. But in this case, in this merger, it is not the case. ICICI Bank, after the merger with Bank of Madura, it is still performing. The reason is, it was a request from Bank of Madura to get merged with ICICI Bank. Okay, so there was not an intention from ICICI Bank to acquire the Bank of Madura. Bank of Madura shown interest in merging with ICICI Bank. That's why the assets and liabilities of Bank of Madura have been merged with ICICI Bank. In this case, ICICI Bank continued to exist. Bank of Madura lost its, the presence, the footprint. Same holds true with Centurion Bank. Centurion Bank merged with HDFC Bank, and they've transferred all the assets and liabilities to the HDFC Bank. So this is called the horizontal merger. You can observe this. ICICI Bank, Bank of Madurai, both are the banks and they're in the banking industry. Centurion Bank, right? HDFC Bank. So both are banks and they're from banking industry. They're merging. So this is called horizontal merger. So now let's understand vertical merger. In vertical merger, two business entities in different stages of production process, they come together and they form a new entity and they merge within the base entity. For example, let's say a car manufacturing company. Okay, let's say Tata. Tata manufacture cars using various components. In some cases it is they import glass, they import steel, they import fiber, they import tires, they import and many more items, right? So when they import so many items, sometimes they feel like instead of importing these components from different service providers, why don't we acquire that particular company and we reduce dependency on the externals. So in that case, companies acquire the company which is operating in the same production process, okay, in different stages. Tata Motors acquired an 80% stake in Trilix, an Italian design and engineering firm. So this is the example, okay? And Reliance acquired Flag Telecom Group in 2010, and that is another example for vertical merger. Conglomerate merger. The third important category of merger is conglomerate merger. So in conglomerate merger, the entities, the companies, the business firms which are merging will have no relationship at all. They'll be from different segments, they'll be from different industries. So they have no relationship within, but still they want to merge. So those companies show interest in merge. Okay, so they want to merge. They want to be part of merger process. For example, the merger of Tata and Sky. You know this. Tata is basically they're into automobile segment. Sky is into 21st Century Fox. They're 21st Century Fox is the company, the mother company, and they're into content distribution platform. They have no relationship at all, but still they come together to form a company called Tata Sky. Now we have understood what is merger. Let's move on to understand what is acquisition. Okay, so before we move on to the definitions and the explanations of what is acquisition, I want you to see an image which gives you an example, which gives you an hint of what is acquisition. You can see this, a big fish, right? So the big fish is eating the small fish, right? So big fish is eating the small fish, and this is eating another small fish. The same holds true when it comes to acquisition. An acquisition is a process of one business entity acquiring another one. In this process, the acquired company ceases to exist while the acquiring company continues to exist. Okay, so in this example, so this is the big company, this is the big fish, this is the small fish. When this big fish, eat the small fish, this will lose its existence and the big fish will continue to exist. Okay, so that is called acquisition. The same holds true with big companies. Some big companies acquire small companies. And when they acquire, the small companies will lose their existence. The big companies will continue to exist and they continue to operate. Now, you must be thinking why? Why acquisition happens? We have seen merger happens because of synergy benefits. Now, why companies acquire another company? Okay, when companies come together, they'll have synergy benefit, that is merger. Now, why companies acquire another companies? There are various reasons why companies acquire other companies. A few reasons are to obtain a specific product. Okay, when it comes to software companies, they acquire other companies just to acquire the software product. To increase the size, to obtain control over the critical resources in the market. Okay, so these are the reasons why companies acquire other companies. These are some of the important reasons why companies acquire. Now let's understand the classification of acquisition. So what are the types of acquisitions we see in real time? Acquisition by consolidation, acquisition of assets, acquisition of stocks. Now let's see what is consolidation, right? Acquisition of consolidation. In acquisition by consolidation, in this, the combination of assets and liabilities of two companies, when companies, you know, they'll have their own assets and liabilities. Okay, so when they come together, they'll transfer their assets and liabilities both. The best example for acquisition by consolidation, a France-based IT company, Capgemini, acquired Nasdaq-listed IT company iGate for 2,500 million in 2015 in India. This was an example for acquisition by consolidation. Now, the second type of acquisition is acquisition of stocks. Okay, so in this, by acquiring the stocks, a business can earn the control over the other business. Example is GIC acquired Nirlon, right? So Singapore-based GIC acquired 63.9% of stake in Mumbai-based Nirlon company, and the value of the deal was 28 million. The third type of acquisition is acquisition of assets. In acquisition of assets, the bidder acquires all the assets of the target firm. The bidder may prefer acquisition of assets to avoid the target firm's liability. Sometimes it is not necessary that the acquisition of assets and liabilities is compulsory. Sometimes the acquiring company may anticipate to acquire only the assets of the company, not the liabilities, or they may acquire both assets and liabilities. It depends on the company which is acquiring the other company. They can choose, they can opt or not to opt for the acquisition of assets and liabilities all the time. Best example, Ola Cab acquired Taxi for Sure. This was 120 million deal. Now, let us quickly have a look at the advantages and limitations of mergers and acquisitions. Now, we have seen that, the examples for mergers and acquisitions. Now, what are the advantages and limitations of mergers and acquisitions? Why companies prefer to get merged with other companies, and why companies prefer to acquire other company? Why companies, like to be acquired by some other companies? Let's understand the benefits of mergers and acquisitions. Let's first have a look at the advantages of the merger and acquisitions. By merger and acquisition, the companies can increase their market share. Okay, so as I said, when the company is operating in Asia and other companies in Europe, and both are market leaders in Asia and Europe, when they come together, they can increase the market share. And in this process, they can reduce the cost and they can enjoy the economies of scale. What is economies of scale? When they produce the bigger quantity, the cost will come down. Okay, the cost will come down. That is called economies of scale. Access to new talent and technology. When companies come together, so they can share technology, they can share human resources, they can share the process, they can share the culture. Okay, so they have access to the resources of each company. They'll have access to each other. When the companies come together, it will be easy for them to face the competition. As I said, I have mentioned in the previous slides. So facing competition will become much easier compared to the competition that individual companies face generally. Access to new marketplaces and tax benefits. When companies come together, they need not pay tax twice. Okay, when they are operating separately, company A and company B, they are supposed to pay 35% or 30% of tax according to the tax laws of the land. They're supposed to pay the tax. But when they come together, they'll not pay two times. They'll pay only one time. That is a tax advantage for the business. Now, what is the dark side of merger and acquisition? Why some companies prefer not to merge or acquire other companies? Creates cultural gap. When company A and company B come together and they want to merge, they come because company A's culture, the company's B culture may not be same. Okay, when they're culturally divergent, when they have difference in cultural aspects, it is difficult to consume. Company A employees find it difficult to adjust with company B's employees culture, and the same holds true with company B's employees. So that is one of the major reasons why companies prefer not to acquire or merge with some other companies. The job loss because of merger, the job loss happens. Exhaustive reskilling because the complete process will be redefined because both companies would have been following different process or maybe conflicting process, so they will not be able to understand the process of each other. They'll be reskilled. Uncertain results. What happens after merger, what happens after acquisition is still a question mark. It is not that we'll not be able to explain how the results would be. It is just an anticipation, it is just a forecast. So the results of merged company, the acquired company, the new company will be very difficult to understand or very difficult to predict. So these are some of the important limitations of mergers and acquisitions. Now, we have mentioned that companies would prefer to merge with other companies and some companies prefer to acquire other companies. Now, what if the company don't want to merge with other company? Okay, so both the companies, let's say company A and company B, both are doing really good in the market. They have their own market share. They have their own client base, a strong client base. Now, the company don't want to merge with some other company, or the company don't want to face the competition, the company don't want to face the acquisition threat. So how they can defend themselves? There are various reasons through which companies can avoid mergers and acquisitions. Divestiture is one of the method through which companies can avoid merger. In divestiture, what happens? Companies generally sell off or close down some of their unproductive cost centers, unproductive business units, which brings unnecessary pressure, financial pressure on the company. And these unproductive units are the targets of the acquiring company. Some companies are looking at the company like they are observing that this particular cost center, this particular business area is weak. We can capture that and we can make their business strong. So that's the perception they have. So to not to give scope for such thoughts, so companies sometimes go for divestitures. The best example for divestiture is Thomson Reuters. They have tried this. They divested some of their unproductive, loss-making business units. They've sold it off and they've cleaned it. Okay, so by cleaning that business unit, they have removed the financial burden and also they have removed the attraction. Like the companies will not see at that particular business units. Spin-off. Spin-off is another method through which companies generally, avoid mergers. They defend against merger. In spin-off, companies establish a separate entity, separate business unit, and the shares of that particular new entity will be distributed to the existing shareholders. So that is spin-off. The example, PayPal. PayPal established a separate business unit, that is eBay, and they've given the shares of eBay to the existing shareholders of PayPal. Split off is another example how business can defend against the merger, right? So in split off, what happens? The entire business is split into various parts, and the shares of that particular segment will be distributed among the existing shareholders. General Electric and Synchrony Financials. This is the best example for split off. Golden Parachute. In Golden Parachute, generally, companies, avoid, merger using Golden Parachute. For example, they announce hefty packages to the existing, board members, and they put a condition to the acquiring company that immediately after the acquisition of the company or the merger of the company, the board members need to be, given that particular reward, the higher reward. And also, if those board members need to be removed from the board, and they should be given a, hefty compensations. Okay, so that will make, the acquiring company, they discourage acquiring company in that format. Crown jewels. What is crown jewels? In crown jewels, company, sold, like before the acquisition of the company, companies will sell their imported assets so that the deal will become unattractive for the acquiring company. Poison pills is another method for defending against merger. In poison pills, soon after the company hear that some other company is trying to acquire business, what they do, they simply borrow money from debt sources, and these debts are taken under the condition that soon after the merger, these debts to be repaid immediately. Okay, so this is called poison pills. White square. In white square, what happens when the company understand that there is some other company is trying to acquire this business? Soon after that, they request their friendly company to acquire some of the important portions, some of the important assets of the business, or take control over the business, some sections of the business. Yeah, these are the examples for each one of this, right? So in white square, that is what happens. And in white knight, what happens? In white knight, majority of the assets will be sold to the friendly company so that the deal will become unattractive. So that is the method companies generally use. White square and white knight, these are two similar methods, but the difference is in white square method, only a few assets will be given to the friendly company to protect, so that the control will be reserved with the friendly company, and the acquiring company will find it unattractive. In white knight, what happens? Majority of the assets will be given to the friendly company, and they'll have full control over the majority of the control over the business, and this will make the acquiring company, they discourage the acquiring company. Now, let us understand. Now we have understood what is merger and acquisition. Now let us understand what is the alternative for merger and acquisition. Joint venture is a best alternative for merger and acquisition. If the company don't want to merge or acquire another company, so they can go for joint ventures. For example, in joint venture, companies come together to form an entity for a specific reason, okay, for a definite reason, and this is for the limited duration. It is not going to be a lifetime activity. This is going to be for a specific reason. For example, State Bank of India and Bharti Airtel have announced a joint venture to offer banking services to consumers. So this is an example for joint venture. Another method, alliances. This is an informal arrangement. In this, businesses come together to cooperate without the need of an equity component. So business come together to cooperate with each other without any financial stake. For example, ICICI SEC enters into a strategic alliance with AM Capital in 2015. Vodafone entered an agreement with ICICI Bank for M-Pesa. Another method which is available is leveraged buyout. Okay, so in leveraged buyout, company purchase and another company by a small group of investors will purchase this particular company, and this particular deal is largely financed through debt. So the debt is used instead of equity. They use debt to purchase this particular deal. Why this happens? Why leveraged buyout happens? This is to raise the necessary funds to acquire control from the existing shares and shareholders by issuing debt. As a result of the purchase, the control is left with a small group of investors, and ownership of the company changes from public to private. An example for this is deal between Tata and Tetley. Okay, so they become Tata Tetley. So this was a deal. This was the biggest ever deal It's a cross-border acquisition and also first ever successful leveraged buyout by an Indian company. So here is a quick recap of what we have learned so far. Corporate finance is a subdomain of finance which discusses largely about the sources of funds and application of funds within the business, maximizing the business returns while minimizing the cost and risk is the ultimate goal of corporate finance. In other words, you can say maximizing the value of stakeholders is the ultimate goal of business. Corporate finance decisions involve around capital investment, capital financing, and dividend decisions. NPV, the net present value, is the present value of an investment's expected cash inflows minus the cost of acquiring the investments. The break-even point is the level of sales or output at which the total cost will be equal to total revenues, and consequently, there will be neither profit nor loss. Capital structure of business refers to the sources from which the business financed its requirements. A merger is a combination of two companies to form a new company. The capital structure of business refers to the sources from which the business financed its requirements. So that's all in this course. I hope you enjoyed this course and I hope you learned. Thanks for watching. All the best. To quickly summarize, we have discussed about the concept of corporate finance. We have discussed the meaning and the background of corporate finance. We have understood corporate finance is part of financial accounting and it is part of financial modeling. And this also discusses about how business acquires funds and how it utilizes them for maximizing the value for the stakeholders. And we have discussed about the goals of corporate finance. So what is the goal of corporate finance? The ultimate goal of corporate finance is to maximize the value of stakeholders. So maximizing the value of business is the ultimate goal of corporate finance. And we have discussed about the stakeholders to the business. So who are the stakeholders to the business? There are two categories of stakeholders to the business: internal stakeholders and external stakeholders. Internal stakeholders are those people who are internal to the organization. They are they may be employees, or they may be managers, or the board of directors. They may be shareholders, or they may be internal auditors, or any other individuals who are internal to the organization. Who are the external stakeholders to the business? External stakeholders are those people who are external to the organization, but they have active interest in the business. For example, they may be creditors to the business, or they may be the suppliers, or they may be the customers or clients, or they may be the government authorities or tax authorities or legal consultants, or any other person or any other individual who is actively interested in the business. They may be the media, or they may be any other external parties. So they're called the external stakeholders to the business. And also we have discussed about the nature of corporate finance decisions. So what are the typical characteristics of corporate finance decisions? So what is the nature of corporate finance decisions? For example, we have understood that the corporate finance decisions are irreversible in nature, right? So once taken, corporate finance decisions cannot be reversed. The business has to face the consequences, whether it is positive or negative. The business has to face the consequences if the decision is taken under corporate finance decisions. Corporate finance decisions are long-term in nature, so they have long-term vision. The corporate finance divisions take the decisions for long-time perspective, and they'll not get into the tactical activities of the business. And the corporate finance decisions are risky in nature, right? So that is high risk decision taken under the umbrella of corporate finance decisions. So every decision taken under corporate finance decisions will have a risk element in it. And we have discussed about the agency relationships, right? So what is agency relationship? This is the relationship arises between the principal and agent. So the principal is the person who actually instruct the agent to act on behalf of his or her best interest. So when the agent and principal work together, the agency problem doesn't arise. And when the agent does not take care of the best interest of the principal, the agency problem arises. So we have discussed about that in detail. I think you are able to remember the example we have discussed about the mechanic and the car owner. So that is the best example for understanding the agency relationship. Corporate finance decisions. We have discussed about the corporate finance decisions. The corporate finance decisions are broadly classified into three categories: investment decisions, financing decisions, and dividend decisions. And we have also discussed about the capital budgeting techniques. So this is part of investment decisions. We have discussed the capital budgeting techniques. So we have discussed the four important capital budgeting techniques: the payback period, net present value, and we have discussed about internal rate of return, and also we have discussed the break-even point. So what is payback period? How quickly the business is able to recover the initial cost. So that is the discussion under payback period. And we have discussed about the net present value that reflects the whether the cash flows received are positive or negative in nature. Okay, if the cash flows received at the end of the duration is positive, we accept the project, and if the cash flows are negative, we reject the project, and if it is zero, we still accept the project. And also we have discussed about the internal rate of return. What is internal rate of return? Internal rate of return is the rate at which the present value of all the cash outflows are equal to the present value of all the cash inflows. So we calculate internal rate of return, that is a percentage, that is the interest rate we calculate to understand at what point the present value of cash inflow are equal to the present value of cash outflow. And also we have discussed about the break-even point. What is break-even point? Break-even point, that this is the point at which the total revenue is equal to the total cost. So every business dream to reach, they'll have a dream to reach this particular point. The moment they reach this point, there will be no profit, no loss. And beyond this point, the companies can start enjoying the benefit of profit. And also we have discussed about the capital structure. We have discussed how the capital structure of any business is formed. We have taken an example and we have explained about that. We have discussed about capital structure with debt, equity, preference, and retained earnings. So sometimes companies will prefer to go for debt, and sometimes they prefer to go for equity, and sometimes they prefer to mix both of them in different proportions. And the last topic we discussed in the course is the merger and acquisition, one of the most important, the trending topic in corporate finance. So why companies merge? What is the merger and what is acquisition? So generally companies merge or acquire other company because of synergy benefit, and mergers or acquisitions are happening because of various benefits they carry. So mergers and acquisitions have started long back, and now in most of the cases we hear about mergers and acquisitions. We hear about these two terms more frequently because setting up a business is the most complicated task. So once it starts, there will be a lot of challenges. So companies prefer to go for acquiring or merging with some other company rather setting up a new business. Or even the individuals, instead of starting a fresh business and building the base for the business, they prefer to acquire the business which is already running in the market. So that's all in this course. I hope you all enjoyed this course. I hope you learned, and now you'll be able to apply these topics in the real life.
I would like to inform you guys that Great Learning has come up with a free initiative called Great Learning Academy, where you will find more than 200 courses in high demand domains absolutely free. Register today and enroll for courses of your choice and claim your free certificate on completion. For further details, check out the links in the description to this video below. If you are a fan of our videos and haven't subscribed to our channel yet, don't forget to hit the subscription button now and ring that notification bell so that you don't miss out on any new updates or video releases from us. And if you enjoy this video, show us some love by liking this video and share it with your friends and colleagues. Make sure you put down all your requests or ideas for new videos that you would like us to cover in the comment section below.